So that's one benefit of conventional PMI, that it's cheaper for people with better credit scores. First, what actually happens with that FHA mortgage insurance, the upfront and the monthly, it actually is deposited in like a pool for the government, so that anytime an FHA loan defaults around the country, they can bail that out, right? It's an insurance to protect the banks against foreclosures.
Insurance policy, yep.
So essentially you're paying for other people's foreclosures. That's what mortgages are. That's what mortgage insurance is. So that's FHA. All right, so let's get FHA out off the table. Notice how the main things, there's upfront and monthly. There is, it's for the life of the loan. And for the most part, it's a flat rate. Okay. Now, conventional mortgage insurance. This is called PMI. And that's because it stands for private mortgage insurance. And it is exactly what it sounds. It's a third-party private company that provides this mortgage insurance, unlike FHA, which is government. And because it's third-party and it's private, and the nature of how it's calculated is they look at you and give you a custom quote. All right. And now it's mainly driven by two things. There's a bunch of different things that are factor into the pricing, but mainly driven by two things. Number one, your credit score. Number two, your down payment. All right. You get significantly better, the better your credit score is, and the larger your down payment. Another thing to mention with conventional, so for instance, same person, same purchase price, same loan amount that we talked about. Remember, it was 0.85% monthly. If I had a 760 score and I was putting 5% down, it would probably be around 0.2%, which monthly mortgage insurance at that rate would be maybe $80, $100 versus the FHA mortgage insurance. It matters more the larger the loan amount, though. If you're borrowing 500, those percentages and those differences are bigger amounts. Yeah. So that's one benefit of conventional PMI, that it's cheaper for people with better credit scores. Second is there's no upfront, right? There's no upfront, just monthly. So your loan amount is actually lower. There isn't that additional cost. Third thing is it's not for the life of the loan. It can automatically terminate at 78 LTV. And you can request it to be removed at 80% LTV.
So that's loan to value for which we did bring up earlier into the episode.
Correct. So basically when you have enough equity, all right? So after you pay your mortgage for a few years, you can request it, or when your property values go up, you can request it, or you wait a little bit longer and it will automatically fall off.